Hello, hello. Hi, everyone. Welcome to our 21 Shares analyst call. Make yourself comfortable. It's going to be a very special session. Thank you for joining. Krian, Ophelia, how are you guys doing?
Good. How are you, Ellie?
I'm doing great.
Great.
What about you, Ophelia?
Great. It's a wonderful sunny day in New York City, so kind of hard to complain.
That's the total opposite in Zurich, unfortunately, but anyway, we're used to it. The whole month was unfortunately rainy, but I come from London before Zurich, so I'm used to some rainy days. What about you, Krian? How's on the other side of the world? And tell us where you are.
I'm in Taiwan and the weather is surprisingly very cool. I guess American wise, it's like 85. Not cool for some people, but cool for here.
This is great. Wonderful. Thank you for joining, everyone. We're going to start in a minute or so.
Yes, it's awesome. I can't wait for it.
This is actually a special day for us, right? We have a new publication. Can't wait to announce it.
Yeah. The cover art is amazing. We always had this dream that this cover art would be like interesting and different every time we did it. When we first started doing like these magazines, it was a huge part of it. And honestly, it's amazing.
Shout out to our design team.
Yeah.
You guys, you nailed it. You really nailed it.
And I have to admit, the content is both very relevant to this session and also like near and dear because it's not something we always talk about in research.
Very true. I agree, but much needed, especially now. Exciting. All right.
It's very accessible as well compared to like Googling ETPs and exchanges and stuff on the internet in disparate places. Like you go through the magazine and man, it's just point after point and just hits the right tone. It was a good read.
This is good.
Trying to test out ChatGPT for ETPs and ETFs to understand what information this thing actually knows. And I have to admit, I basically got back unusable garbage. And I'm like, okay, perfect. This is going great. It's not just that Googling doesn't work. Apparently, chatbots do not work either, no matter how smart they are.
I agree.
That's a true story.
It's a true story. Word. Let's go.
Welcome, everyone, to the latest 21 Shares analyst call hosted by Ellie, as usual. Eliézer Ndinga is the director of research. We're joined by a very special episode of Ophelia Snyder, the co-founder and president of 21 Shares, on her debut on the 21 Shares analyst call. Today, we have some exciting news. The latest State of Crypto issue number 9 is out. So if you're on Twitter, if you're on LinkedIn, you would have seen the cool cover art that we were just talking about a few seconds ago. If you haven't, you can have a quick look and come back straight here to the analyst call. Today's session is going to be a little bit different. Ellie's going to moderate. He's going to have a bit of a fireside chat. So if you've ever joined one of those, you'll know what to expect. After that, as usual, if you have any questions, drop them in the chat. Ellie and Ophelia will get to them as soon as they can after we go through sort of the main body of today's analyst call. And without further ado, because we have some awesome stuff to talk about, Ellie, I'll let you take over.
Thank you so much, Krian. Ophelia, we're so incredibly excited to have you here. You have no idea how this is so important to hear from you about the whole innovation with crypto exchange-traded products. Sometimes people call them exchange-traded notes or exchange-traded commodities. And I think first, even before that, I think the audience would love to hear about you. Who are you and why you actually started 21 Shares with Hany In, our CEO and co-founder?
Yeah. Crazy enough, it's been almost 5 years. So we're celebrating our 5-year anniversary of our product suite in November. My background's actually weirdly unconventional for what I do. And I started my career as a scientist, got really interested in finance, got really interested in like structuring, which I realize no one else is actually that into, but I think is super cool, like complex deal structures and like why financial products work the way they do. And I was working at a bank. I worked at UBS and then at another bank, American bank called Evercore, doing these kinds of deals. And one day I started chatting with Hany, who'd been a friend of mine for 12 years, about crypto and the fact that like our moms were trying to invest. And my mother is a shockingly brilliant woman who came to me in 2013, 2014, telling me about how she fundamentally believed that we needed a global reserve currency because businesses like Merck spent way too much money actually hedging currency exposures, and a standardized means for exchange for the world could be a tool for increased globalization, peace, and financial growth. And I believe in Bitcoin. I'm like, what are you talking about? I'd heard of Bitcoin before, but that was one of the first people to actually make a concrete, like, economic case for crypto. And what was super interesting was my mom never actually invested. And the reason she didn't invest, and actually the reason Hany's mom didn't invest either, despite a very different set of reasons for finding it interesting, is that there wasn't really a good way to do it. You were talking about either opening what essentially amounted to like new bank accounts in order to make one investment that you then had to like track and monitor separately from the rest of your portfolio. You couldn't go through like your wealth advisor. You couldn't talk to any of the people who help manage your financial life. It was just such a separate thing. And also at the time, who's Coinbase? Are they safe? What is this? Why am I giving my social security number to a company I've never heard of? A lot of, quite frankly, like very valid commentary. And she just never could get past the infrastructure. And so 2018 came around and Hany and I were talking, and his mom was having the same problems, just being completely unable to allocate to the asset class. So we set out to literally build a product for our moms, something that would allow them to enter this market without needing to set up a bunch of stuff to do. We didn't really set out to build an ETF. We didn't really set out to build an ETF platform. We didn't really set out to build a company. We actually just wanted to solve like a very simple problem and build high quality investment grade products that we felt comfortable putting our mothers in, because at the time, what was available were very opaque structured products or things that were trading at significant premiums to NAV to the point where the investments didn't really make much sense. And so we went to 27 different countries and tried to figure out what the best way to structure it was. And Switzerland, with this wonderful combination of a history of neutrality, a deep history with gold and gold-related products, was just such a perfect fit. Crypto is so well aligned with the country's mission and vision for the future, with the existing financial infrastructure, with the existing regulations, that we launched the company in Switzerland. And obviously, Switzerland's our headquarters. I'm calling in today from our New York office, but we've since established a really wonderful Swiss presence and have built out a much larger range of crypto exchange traded products than, candidly, I ever imagined when we first launched the company. We're now running nearly 40 products covering everything from single assets, shorts, indexes, staking products, you name it. And we've been first to market with essentially every single one of those features. So that's how the company got started.
This is wonderful. And what is even more fascinating is because you guys built another way to invest in crypto, another way that is very similar to ETFs, but at the same time, they're not really exchange-traded funds. Can you tell us more about the differences and the commonalities between these two structures, especially for the audience here?
This is the complicated thing with exchange-traded products. In most of the world, exchange-traded products is actually an umbrella term that's a combination of exchange-traded funds, exchange-traded notes, exchange-traded commodities, and a bunch of other things. In Switzerland, ETPs are a defined term. In other countries, they're not. So these names kind of shift depending on where you're coming from. Ultimately, it's actually not that different. They work the same. There are some differences in legal structure and some differences in which regulations they fit under. But essentially, an exchange-traded product, whether it's structured as an ETF or an ETP, actually has the same mechanism of trading at NAV, so at the value of the underlying assets, with a direct claim to those underlying assets, using market makers to keep the market in line and letting them in and out of the products on a daily basis. From a customer experience, from like an investor experience perspective, there really isn't that much of a difference. Some of the differences come from like legal. So ETPs are structured as debt instruments. ETFs are structured as fund participations. And some of the regulations around this require it to be that way. So most ETFs have things like diversification requirements. People calling in from Europe will be familiar with UCITS wrappers. And obviously, you can't fit a single asset product under UCITS. It's never going to meet those diversification requirements by design. And that's true of gold, of silver, of platinum, of Bitcoin, of you name it. So there's also very real reasons to structure products in one way or in another. And currently, we don't really have products that are sufficiently diversified to meet UCITS standards. So this is the better product wrapper.
I agree. Interestingly, back in 2018, when you guys launched the first products, it was not the first product on the largest crypto assets in the world, which is still Bitcoin, but it was a basket. Can you tell us more about why we started with the baskets compared to single assets?
So There's really a couple of reasons.
And it's a cool name as well. We'll get.
So there's a couple of reasons we started with indexes. And actually, our index line are still some of my favorite products in our product suite. The reason for that is crypto moves really fast. Crypto is constantly changing and reinventing itself. And it's actually really difficult still today, let alone 5 years ago, to know which assets were going to win, to know even which themes we're going to win. Is it going to be DeFi? Is it going to be NFTs? What's the killer use case? A lot of this, it's still not the most transparent industry in terms of like people being able to actually understand what each of these underlying assets do and how they work and why they work that way. And we spend a lot of time and effort doing education around that, but it's not always that linear. And these products allowed you to actually have diversification and provide an easier entry point. It's the reason why things like the S&P 500 ETFs are really popular versus necessarily picking single name stocks. The amount of information you need to be able to say, I really believe Ethereum is going to outperform Bitcoin over X time horizon is significantly both more specialized and very different than the information you need to be able to say, I believe that this technology holistically is going to work. And so that's really where we started from. And we wanted to actually offer that diversification. And that index was built in a bunch of really interesting and funky ways to count things like the enhanced volatility in crypto assets, different ways of calculating market cap, different ways of actually thinking about this market. And it really did provide that broad-based view. And I agree with Ellie, the ticker is amazing. It's HODL.
What does it mean? What does HODL mean?
So HODL is a bit of a joke actually from crypto, like an inside story. It means hold on for dear life, meaning to ride the roller coaster of volatility in crypto. And the reason it came about was actually a typo. Somebody made an error in a tweet, and a sort of story was born around the fact that this wasn't just hold, this was HODL, and it was the next step of what a long-term buy and hold strategy would look like. And if you actually look at our product suites, you can obviously use them to trade volatility if you want to, but really the key piece of our product suite, the thing we've always built for people who are interested in that long-term investment thesis driven entry points into crypto and really providing that for long-term holders. And we've really dovetailed very nicely with our core thesis there.
I agree. And it's interesting because we don't just have baskets, but we also have single assets. And of course, we are providing a way to invest in crypto very differently from like other ways to invest in crypto assets with exchanges or wallets. We're going to get to the differences and the advantages of an ETP structure, but tell us why this ETP structure, this investment vehicle, is a must-have for so many investors, especially the more regulated financial institutions.
So it does a bunch of really good things for you. It eliminates a lot of the confusion. People know how they fit, they know how they're taxed, and they fit within your existing tax reporting structure. They fit within fund mandates because fund mandates actually allow you to do things like invest in ETFs and don't necessarily allow for the opening of new infrastructure. You're not running your own infrastructure to make a couple of investments that maybe amounts to a few percentage points of your total allocation. You're not running your own infrastructure. There's no expectation for you to do that. You're essentially allowing us as a company who live and breathe ETFs all day long and live and breathe crypto all day long to guide what best in class infrastructure looks like. And so you're able to get access to things like best in class custody solutions, both in terms of security and in terms of insurance, neither of which are actually available to people outside of making multi-million-dollar allocations with single custodians. So we're actually able to do that across multiple custodians, provide access to custody products and trading products that are typically just not available outside of the very high end of the crypto world. The other sort of benefits to this, quite frankly, is that you have a very different claims structure. And this is going to sound like really uninteresting and boring, but it's actually what protects you from bankruptcy. And as we've seen, assets held with exchanges are not necessarily protected from bankruptcy proceedings, and there's no requirement that they give those back to you on a timely basis. Like the way we've structured these products, we hold them in segregated custody. So each product has its own custody pool. They're 100% backed by assets held in segregated custodial accounts. Those custody accounts are overseen by a trustee. So if, for example, tomorrow 21 Shares no longer exists, we've gone bankrupt, the trustee has the legal right to enforce on that collateral and return it in a matter of days. It doesn't form part of the bankruptcy estate of 21 Shares or of the custodian. So it's this very nice, very separated structure. We're not commingling those assets amongst our own products or with anybody else's. And so when things happen, what we've seen in the last year or so in terms of, quite frankly, like insolvency risk and counterparty risk in crypto, like this really does protect you from that in a much stronger form than holding assets on exchanges or holding assets in other structures.
No, I couldn't agree more. And I think there is another part that is so important as well with exchange traded products or even exchange traded funds is the liquidity, right? Especially in the secondary market. Can you tell us more about that part of the structure? Because you mentioned already the primary market, especially when the assets are ring-fenced away from us. But tell us more about, especially here, the liquidity that is, to me, the engine of some of these ETPs.
So liquidity in these assets, there's a couple of different ways you can think about ETF liquidity. And typically, like the first way to think about it is essentially because you're able to come in and out of the product every day, it essentially has the same underlying liquidity as the underlying market does. So these products will be about as liquid as however liquid the crypto market is that underlies it. So that's the first kind of piece to realize is that actually, because you have the ability, you could come in and out with $1 billion a day and nothing is going to happen to this product structure. It's going to perform exactly the same way. And if you look at like the broader ETF world, that in fixed income, that in equities, these products are structured in such a way that they can absolutely handle that. And so their liquidity will mirror the liquidity of the underlying asset. In terms of like trading liquidity in secondary markets, so what most investors are actually interacting with, you have some of the largest market makers in the world supporting these products. And the reason, quite frankly, it's what allows these products to trade at the value of the underlying assets. You're able to come in and out whenever you want. These aren't private funds where you'll get your money back in 30 days, maybe. These aren't even necessarily exchanges where it can take days to process your sell orders. Essentially, here you're able to transact immediately and have that cash released back into your brokerage accounts to do whatever else it is you're trying to do. And it fits within the standard settlement structure that everyone's already working with. So a lot of these mechanics are not the sexiest thing in the world, but it does mean you're able to come in and out whenever you want in a fully liquid product. T+1 settlement, going to settle the way you expect, and it's not going to give you any sort of nasty surprises of, oops, this didn't happen. And that's actually really important. Predictability in financial structures is basically the whole point. And one of the things I'm most excited about when it comes to our product suite, and quite frankly, like proudest of, is they're super predictable in the way they behave. They will do exactly what they say on the label, and that's the entire point of them.
Yeah, I couldn't agree more. But you know what is even more important, especially when we've seen last year, not just like bankruptcies, but also outages. Can you tell us more as well how important is the ETP structure, especially from the liquidity perspective, when it's possible that we have one exchange that goes down, not just for bankruptcy purposes, but also for the fact that they are having technical issues where it's impossible for any investors having access to an exchange to basically trade on the exchange. The diversity of liquidity, I think, is very important. And maybe you can walk us through how the ETP structure really helps to, I would say, weather the storm.
So it's a really good point. Typically, if you're going to go buy crypto, you're going to go to a exchange, like a single entry or exit point into the space, right? You're going to go to Coinbase or you're going to go to Kraken and you're going to open an account and you're going to have one account that you're trading out of. And that makes sense for most people. That's not how market makers actually do things, right? So they will be working across essentially every major exchange. And so the way we work with our market makers is essentially we create a whitelist of liquidity venues. Yep. So they're able to trade on sort of exchanges and platforms that have robust KYC, have robust AML practices. So you know that the assets that are coming in and out of these products are clean, have a clean track record. There are no issues with that, but it does mean that if any individual venue goes down, they can actually shift liquidity pretty quickly across venues. So you don't end up with those issues of, oh, there's a lot of trading volume today in Ethereum because there's a new upgrade that's come out and Coinbase has gone down because suddenly everyone is trading at the same time. You're not subject to those kinds of issues because you're actually able to diversify that exposure. And one of the things we actually prioritize in our infrastructure is that diversification. We diversify market makers, we diversify liquidity venues, we diversify custodians, we diversify accounts, we build diversified products. It's actually a really good way to spread risk, essentially removing a lot of like infrastructure risk and spreading risk across the asset class. And it's a really important theme for us. I think I mentioned this already, like products should do what they say on the label. You should be taking the risks you want to take, right? I want to take a risk on the direction of Bitcoin. I want to make an investment and I believe it's going to go in this direction. I want to be able to do that. I don't want to be taking other risks associated with that. I don't want to be taking counterparty risk, liquidity risk, default risks, like all of this other stuff that really you're not getting compensated for. And we spend a lot of time within our infrastructure trying to minimize.
So there's one thing that you mentioned as well, which is very important, is that our ETP structure is fully collateralized. Can you tell us more about the concept of coin entitlement, especially for the investors that do have exposure to our products? How can they find how many Bitcoins they have, for example, with one share or like 100 shares of our ABTC product or any other product that we have? Can you tell us more about this concept, which is actually very powerful for investors to know how many BTC they have in cold storage?
It's quite simple, actually. So when we talk about segregated accounts, what we mean by that is there's literally an account with all of the assets associated with that product. And it's not actually one account, it's typically dozens. Again, going back to diversification. But the idea is each product has accounts associated with it that contain all of the assets required to fund the entire obligation to investors.
Yeah.
And so what that means is essentially if one share of the TP is worth 1 Bitcoin, that 1 Bitcoin exists in these accounts. And every one of our products has a specific amount of crypto associated with it per share. All of that information is on our website, so you can pull them for every single one of our products and you can pull them every single day. We take our fees out in kind, which means that entitlement will actually decrease a little bit day over day. And the reason we do that is so that, quite frankly, investors are not impacted by any FX risk on fees. So it's not, oh, you're paying the manager on NAV, but between the time that NAV was struck and when you're actually paying them, there's some discrepancy. We take it out in kind. These products exist in an entirely in kind and crypto denominated structure. So there's actually no impact from that volatility on performance of the product itself. And you can actually see that represented in the evolution of those coin entitlements.
No, absolutely. There are different ways to invest in crypto. When you started your crypto journey, there was crypto exchanges and investment trusts, and that expanded with wallets and decentralized exchanges. And we have also decentralized lending platforms. It's a very fast and evolving class. But can you tell us about the differences and the advantages of our structure compared to any other structures? Let's start with, like, for example, crypto exchanges, but then let's go with the long tail of, I would say, the adventurous vehicles that exist today for people to have exposure to different type of crypto assets.
So versus exchanges is really a lot of the things we've already talked about, right? It's that availability, so you're not taking any technical risk. It's the segregation of the assets, so you're not taking bankruptcy risk and you're not commingling your assets with others. So essentially, you're not a creditor of an exchange, right? And I think the jury is still out in most jurisdictions as to whether or not people's crypto assets on exchange form part of the bankruptcy estate or not. And as we're seeing with FTX, it's not that easy to get your money back. And it's not that easy to get your money back at the time you want to get it back. So unlike purchasing these assets through exchanges, you're not mixing your money with other people's. That money is being held separately from everyone else's, and it's being like 100% backed. So for example, no one's trading derivatives off of that. No one is leveraging off of that. You're not providing leverage to others. These products are quite simple and quite transparent. That's one of the major benefits versus something like a crypto exchange. As you start to go down that long tail, transparency and fees becomes an increasingly big problem. You know exactly what you're paying. We're not like hiding fees and what it takes to come in and out of that product. We don't charge people to come in and out of this product. We don't really do anything associated with that. You're able to see very clearly what the total expense ratio is. Products you're purchasing, you're able to see the payment of those fees over time on a daily basis in a transparent way. And that's really critical, especially as you start to think about things like structured products and some of the more sort of esoteric fund structures that we've seen come up in the space. That transparency around like what you are actually paying the manager is really critical. Additionally, when it comes to things like structured products or ETNs or some of these things where you're actually taking counterparty risk against the issuer, that's not really the case here, right? The segregation of those assets and some of the protections from this legal structure actually allow you to have those claims and have those claims regardless of our status from a bankruptcy perspective, where structured products typically actually do exist on balance sheet. And as you get even further into that long tail, especially in the United States, products actually trade at the value of the underlying assets. And it's because you allow the market makers to come in and out of these products on a T+1 basis. That liquidity we were talking about is a huge part of how you're actually able to trade these products and move in and out of them. That's a very different approach and structure, and it's a lot cleaner. So for example, something like Grayscale has baked into it an additional thesis, which is whether or not think a Bitcoin ETF is going to get approved in the United States. That affects what that premium discount structure looks like over time and how active you think the institutional market is relative to the retail market in the United States at any point in time. That's actually what impacts that sort of discount to NAV. That's not the case here. We're trying to actually provide products, and we do provide products that very simple what your investment thesis is. I either think crypto as an industry is moving in an interesting direction. I want to take broad-based exposure to that. I think Bitcoin and Ethereum are super important. I want to take a weighted average of those two because I really think they're going to drive crypto adoption. I think the price of Bitcoin is going to go down and I want to go short. That's the only thing you should be doing. You shouldn't be also taking all these other sort of investment objectives unless there's something you actually want to do, but it's typically not marketed or sold that way. So one of the things that's really important with these products is they're deliberately simple. They're complicated to operate and there's a bunch of stuff happening in the background, but from the investor perspective, they're supposed to be clean, simple, and very straightforward to use.
And this is our motto, right? Make crypto easy. And this is really exciting because I would love to hear your thoughts about your view on the space, anything that you're super excited about, because when you and Hany started the company in 2018, we had also a bear market. It was completely different from the bear market we're experiencing today. Of course, the asset class is arguably 5 times as large, especially from some developer ecosystems like Ethereum and then also Bitcoin. But tell us more about what are the things that in 2018, you were super excited about that today you would be also equally excited about for the future of our space, especially going forward.
So a couple of things. I think our space is you're right, it's a very different kind of bear market. I've actually never been more excited about our space. And I know that sounds like a cliche, but if you think about all the major steps forward crypto's taken in the last 5 years, they've all come out of bear markets, right? Probably themes most people are going to be familiar with, NFTs and DeFi. All of that infrastructure was built in the last bear. There's a common trope in crypto to say that bears are for building, and I think that's very true. And if you look at what's happening in the ecosystem right now, there are a lot of very important, very large technical steps forward that have happened in the last 18 months, right? The transition of Ethereum from proof of work to proof of stake is enormous. And then the opening of withdrawals for that proof of stake protocol is also enormous. Essentially, you've changed the way Ethereum validates itself from a very energy intensive thing to a basically energy neutral thing. So you don't have as many ESG considerations. The network is as secure as it's ever been. You've essentially transformed Ethereum into a yielding asset so that it looks and operates very differently inside of people's portfolios. You're now able to do that with liquidity. So you're not locking away your assets for an indefinite amount of time. And we've moved into just a very different structure of market for something like Ethereum. And that's what bear markets are about. They're about these inflection points. They're about seeing these technological leaps forward. And Ethereum is obviously a massive asset and very public in terms of what they're doing. Not every project, not every company in the space has that kind of platform. So most of the innovation that we're seeing, and I like to keep up to date on this kind of stuff, obviously, given what my job is, it's amazing. We're seeing transitions in terms of how we think about custody, We think about both institutional and retail access points, clarity in regulations, improvements in how we think about KYC and AML and how they're adapted to the space, better on and off ramping, changes in the capital markets infrastructure, which right now are challenging, but will ultimately lead to, quite frankly, some really good things. We've seen actual challenges in the stablecoin space and pegs and products that continue to operate despite bank runs, which is, again, remarkable. You can't really underplay these things, and they're hard to see. It's hard to see that narrative come together, but I think we will end up looking back at this bear market in a similar way to the way I look at the bear market from 2018, which is this is the right entry point in this market. If you're thinking of starting a business, it's the right entry point in this market. If you're thinking of investing in this market, it's the time when those innovations are being developed, but are not necessarily public yet. And the things that will catapult the industry into its next phase are all being developed today.
And honestly, there is a lot to unpack as well. When we think about how the space is going to look like, it's impossible to have a clear picture, but there are some patterns that we're looking into, as Ophelia said, with the developer traction, the custody solutions. So all the problems that we're seeing in crypto today are going to be solved very soon. All the issues with user experiences or wallets or security, clearly we have some of the best entrepreneurs really trying to fix those. And that's why it's so exciting to see where the space is headed, despite, of course, the price movements. This is super exciting. Now we are moving on to the Q&A session, and we already have a question from the audience. So number one, is 21 Shares planning to expand to other countries? Asia seems to be quite exciting.
So the short answer is yes. We're constantly looking at providing products in additional geographies. A lot of what determines where we go is regulations. So we're typically engaged with governments and with regulators in most major jurisdictions, trying to understand and work with them to develop infrastructure to allow for the creation of these types of products. And essentially anywhere we can, we will.
Yep.
We're very interested in expanding that footprint because we actually believe, crypto is by its definition a global innovation. It's a global product. And we want to make sure that we're providing those bridges, connecting TradFi and crypto everywhere we can.
This is great. There's another one. Okay, superb. Which sector in crypto really excites you the most in this current bear market? That's a question to you, Ophelia, as well.
This is going to sound nerdy, but I love financial infrastructure. I love the plumbing of what makes finance go. People assume financial infrastructure just operates. But if I take my Swiss bank account at 𝕋𝕗 and I go to Kuala Lumpur and I put my debit card in a cash machine, I will put in a code and money will come out. How is that possible? How is a bank in thousands of miles away comfortable actually providing me with cash on hand against a credit obligation from a bank they may or may not have a direct connection to? It's kind of amazing if you think about it. But by the way, like most people use their ATM, walk away, and never think about it again. And that's the thing about financial infrastructure. It's this invisible layer, but it is actually what makes, quite frankly, our economic world go. And in the current bear market, that's super exciting. There's so many movements forward in terms of those types of products. DeFi is great, and DeFi was a big driver in the last bull market. I think what we're going to see now is actual large-scale DeFi. DeFi has primarily been a retail market, right? Testing out new innovations and seeing if you can build things this way. The next step is going to be, what's the value of a wire transfer? Right?
Yeah.
Is that something a human needs to do at a bank, or is that something you could do on a peer-to-peer basis? Is that something you can do instantaneously? And you're starting to see real blockchain-based solutions to these problems. And I think that's amazing. And it's going to be built on platforms like Ethereum. Those are the kind of innovations I'm excited about. How do we get more people in the space, and how do we get those use cases more integrated with current financial markets? I'm not a believer in the fact that like crypto is going to make Goldman Sachs obsolete. Goldman Sachs's primary value add in the world is advice. Is advice and is trust and is their relationships with their clients. It's not really their ability to send a wire transfer. And although, yes, they can send a wire transfer. So I think there's a world where the infrastructure exists on a blockchain and the advice is still provided by a human being. And I think a lot of what I'm excited about in terms of development are those types of things where we're real infrastructural shifts.
No, I couldn't agree more with you. And I think like one of the best analogies as well to look at these disruptive patterns is to understand how the internet disrupted some brick and mortar companies. And when we think about the New York Times, the Wall Street Journal, they were way before the internet came out, even the ARPANET itself in the 1960s. Of course, like crypto can be disruptive in some ways, but most importantly, the technological leapfrog is going to be how to find convergence in some of the most important use cases in value transfer, in file storage, and more as well. And that's why today we have social media companies like Twitter, for example, but they didn't really replace to some extent still the National Geographic or the Wall Street Journal or the New York Times. And we're going to see the same as well with traditional finance, in my opinion. I couldn't agree more with you. There's another question on the back of what you just said as well, which is what will be the killer use case for crypto to onboard billions of people, in your opinion?
I think it's a lot of this. It is absolutely not a sexy answer, but I think it's a lot of this financial infrastructure stuff. I don't think most people, I think it's either that or potentially some of what's happening in social or gaming. I think one of our downfalls in crypto, one of the things we do terribly, which is part of not uncommon for where we are in adoption cycles, is we sell technology. That's not actually the point. We don't sell use case. And I think that's changing finally, right? We're understanding that user experience actually matters. So where do we deliver really good user experience? And does that user experience necessarily need to be, hey, by the way, you're interacting with a blockchain? Is that of value to somebody? Not really. Does anybody care if your website was written in Java? No, I don't think the average consumer doesn't actually care about that. This is just the best way to do certain things. And I think we're moving towards a world where that's increasingly going to be the case. I think it's also the case for a multi-chain world. Blockchains are becoming more specialized. They're able to provide better support for specific use cases so that we can start actually creating those magical experiences. It would be really amazing if you could move the profile that you've developed on and the characters you've developed in one video game to the next one, right? And actually start to create interconnected experiences. That's a huge thing, right? How do you think about ownership? If you think about the amount of money people are spending on Roblox, that's real. People are spending real money for digital goods. How do you think about ownership, right? How do you think about the role of ownership there? And so I think it's going to end up being a combination of invisible financial infrastructure that people don't even know they're interacting with and very visible use cases that provide that magic. And I think gaming is a very attractive one. I think there are a couple others. Notably, I think NFTs are like that, memberships and fan rewards and collectibles. And also the idea of some of these smart contracts platforms, the way they're being developed to allow people to actually create more customizable contracts is really interesting.
No, I couldn't agree more. So we have one last question, which is what adjacent products and businesses do you think about next for 21 Shares? So that's the first question. Another innovative Swiss company, Sygnum, positioned itself as a crypto bank. Is that interesting for 21 Shares? Thank you, Aaron, for your question. Ophelia, go ahead.
So we as a company are really interested in convergence. And we've talked about it a lot on this call, right? It's this idea of bridging TradFi and crypto and making that more seamless for people. And it's a lot of what I'm talking about around financial infrastructure. And I think for us, that's really what's interesting. How do you build blockchain-based financial products that provide real tangible user benefits while allowing these two systems to operate more closely? So something most people don't know is that most ETFs are run like Frankenstein instruments. They're largely held together with like duct tape and a little bit of glue. And most of that duct tape is people emailing each other spreadsheets. And by the way, that's how like S&P 500 funds are run. That's actually not how we run our funds. We built a ton of technology to enable these things, but that is the industry standard. And because they're these sort of very complicated, very difficult to operate products, it's a really interesting use case for blockchains, because actually it's like 12 to 15 siloed counterparties agreeing on accounting transactions every day and publishing that transparently to the market. It's a wonderful use case for tokenization. And these products spend an enormous amount of money on maintaining that infrastructure, which isn't particularly value additive to customers beyond the provision of the ETF itself. So we're really interested in those types of things. And I think as we think about the future of the company, it's very much centered on this idea of convergence and how can we actually build out that tooling. to allow sort of asset management to be a more efficient market and a more transparent one.
This is wonderful, and I couldn't agree more. This is an exciting future for the space, but also for the company itself. Ophelia, thank you so much for your time. We're already at time, guys. Thank you so much for your attendance and your time. We hope you enjoy the session. After this call, you're going to receive the recording, but most importantly, our latest magazine alongside all the research reports that we publish as well. Ophelia, where can we find you on social media? LinkedIn, Twitter.
You can find me on LinkedIn, and you can also find me on Twitter. My Twitter handle is Ophelia B. Snyder.
Great. Perfect. Krian, thank you so much for joining as well. We hope you enjoyed the session, and we wish you guys a wonderful day. Thank you so much. Bye-bye.
Thank you.
Thanks, everybody.